Hi, welcome to EQD Research Global Insights for Friday, May 14th. Today it's going to be all about fading the recent move in VIX, along with something that may have indicated the stock market sell-off would be short-lived this past week. But as always, before getting started, please help us out. Hit that like button. It helps us with the YouTube algorithms. Please subscribe to our channel if you like what you see. And if you really want to be timely, make sure you hit that little bell down there to give you notifications when our videos go live. Now, as of midday today, the S&P 500 is up 1.3%. VIX is down 393 to 1920. I did include this past Wednesday on the term structure chart. So we've got three curves sitting up there right now. VIX closed at 2759 on Wednesday. That's the highest level since early March, late February or so. And the May future, it was at 26 on the day, and that was a discount of $1.59 at that point. So we were in backwardation for, now we're just kind of flat, but we were in backwardation for good part of the week if you count it in hours this past week. Now, VXX, this is a market I don't talk about much, but it's a market that I like to check in on the options on whenever we get a move up in VIX and then a move back down. It did reach as high as 49.95 during the day on Wednesday, almost hit that 50 level. It's currently just a bit under 40. Now, midday Thursday with VXX at 44.10 and already starting to work its way down. Somebody came in trading the standard July option contracts. They sold 1,000 of the VXX July 50 calls for $613 each. And then they bought 2,000 of the VXX July 34 puts and paid $201 each for those. So this trade actually brought in a net credit of $2.11. Checking in on, well, you can see on the payoff diagram first, we can see there's a lot of risk above 50, but if VXX works its way lower, this trade may also realize some substantial profits. It starts to do very well if we get into the low 30s, upper 20s by the summer, which is very possible with the price action in VXX. Now, I did price this one out since the trade's got a little time behind it already, and it has an unrealized profit of well over $4 a spread already. And I'm also going to keep an eye on that 50 call line. Personally, I would be thinking about closing that out. It's offered at 360, and on that leg of the spread, there's already an unrealized profit of $2.50. So end up with a profit of that profit of $2.50. You got the credit that you took in before, and you got a couple of puts that could pay off quite nicely between now and the third Friday in July. Now, turning over to VIX. In the VIX arena, there were lots of large opportunistic short volatility trades. I'm just going to focus in on a couple that were way out of the money from Wednesday, but I really had the pick. I could spend a couple hours talking about the trades that showed up in the VIX arena this past week. Now, Wednesday with the June contract at 24.80 and spot at 24.75, basically right there in line with each other. Somebody came in and sold 86,800 of the June 50 calls for 88 cents. They bought same number of the June 60 calls for 57 cents, took in a 31-cent credit, and as long as VIX remains below 50, between now and June expiration, this trade will realize the profit of 31 cents. And then mid-afternoon on Wednesday, a little bit later, with VIX at 26.60 and the May contract at 26.35, pretty much in line with each other there. Somebody sold 64,550 of the May 55 calls for 33 cents. They bought the same number of May 65 calls for 20 cents, took in a credit of 13 cents. They got a risk of $9.87, but just like that other spread, VIX has got to get way up into the levels that we have not seen pretty much since last spring when the pandemic situation was starting to erupt. Again, they took in a credit of 13 cents. They got a risk of $9.87. And they are pretty much going to have to hold this trade through expiration next week to realize that 13-cent profit. So I'm sure they're going to be watching VIX very closely over the next few days. They're going to be, like myself, they're going to be tuning in on Sunday night to make sure nothing over the weekend caused a big big adjustment in the equity markets. And then finally, this week's volatility, one of the reasons that people were attributing equity market volatility was potential inflation. Inflation expectations will work into interest rate expectations. And when I think about interest rate expectations, I check in on the CME FedWatch tool. Last week, I talked about it. The odds of a hike by December midday last week in response to the employment number actually dropped to about 7%, finished the day at 9%. And check this out. It's been at 9%, held steady at 9% for all 4 meetings this week. It's been kind of a flat line since last Friday. Whenever the market's reacting to inflation, as I mentioned, I like to check the FedWatch tool. And the fact that it was pretty steady this week, regardless of what was going on in the equity markets, that's an argument that inflation, at least the market's not buying into some sort of dramatic inflation by the end of 2021. But of course, whenever we see something going on in the equity markets and people bring up inflation, I'm checking in on the CME FedWatch tool and seeing what the derivative markets are telling us. So with that, thanks for joining me for EQD Research Global Insights for May 14th. If you made it this far, you have to hit the like button, and we always appreciate it if you do subscribe. If you have comments or any constructive feedback, feel free to leave them in the chat area below, in the comment section below. If you've got something a little more extensive, something you'd like me to talk about, adding extra curves to the VIX charts is something that came from one of you guys, feel free to use my email address, rhodes@eqderivatives.com.